So now we'll do some bond retirements. We've issued bonds, we've paid the interest on them, we've done the straight line method, the effective interest method. Now we have to retire the bonds. So the easy one is when we are retiring the bonds at their maturity, and if you had my favorite $100,000 2-year bonds payable, this would be the journal entry. That is such not a problem. Okay, the bonds are always retired at their face value, no matter what they were issued at. Okay, so now, what if the company decided to redeem the bonds before the end of their life, say at the end of year 1? In that case, there would still be some, if they were issued at a premium or a discount, there'd be some unamortized premium or discount to deal with. And so we have to learn how to account for that. Also, when a company is buying back its bonds off the open market, it has to pay the going price for them, the current market rate. So we will have bonds that can be redeemed at 98, which means they have to pay 98% of the face value to redeem them, or 102. So let's take a look at how this would work. If we're redeeming our bonds before maturity, the company can retire them, call them in, you know, a lot of different terminology there. But basically, you keep in mind the bonds are coming off the books, you're paying out, the company is paying out the cash to buy them back. So if we say the bonds are retired at 105, it means they had to pay the face value times 1.05 to buy them back. Retired at 97, you can see where that goes. Okay, so what does this do for our journal entries? Basically, the bonds come off the books at their face value. Any premium or discount associated with them has to be removed from the books. Just like if you were selling a piece of equipment and it had some accumulated depreciation. You can't sell the truck and then just leave the accumulated depreciation hanging around on the books. It's the same here. If you're buying back the bonds and they're coming off the books, you can't leave any unamortized premium or discount hanging around without them. Okay, so let's see how this works out here. So if we're retiring bonds that were issued at a discount, and we're calling them back at the end of 1 year instead of 2. So this is what the T accounts would look like. You'd have the bond on at 100. You'd have the discount that was being amortized, but only 1,000 of it has been amortized so far. So you've got an unamortized or remaining discount of 1,000. At the end of year 1, the company retires the bond at 105. So let's just look at the journal entry about what happens here. Okay, so the bonds payable come off the books at their face value. This would be step 1, or yeah, however you want to do it. And step 2 would be, okay, we got to take off we got to figure out how much cash we had to pay. Well, the cash paid out was 100,000 times 1.05. The bonds come off the book at their face value. The discount remaining has to also come off the books. So there we're crediting the $1,000 discount to get rid of that. Any difference between the two is going to be a gain or a loss on the bond redemption. And in this case, it's a loss. Okay? So that's if we had retired the bonds at, what, 105. What if we retired the same bonds at 97? Let's see what would happen there. You can kind of go through the thought process. The bonds are retired at 97. That means we've got to pay out 97,000. The bonds come off the books at their face. We have to get the balance in the discount off the books as well. And then we have the difference will be a gain or a loss. So here, you can see we paid out the 97 cash, took the bonds off, here's the discount, and in this case we had a $2,000 gain on the redemption. Okay, so now for a premium, it's the same idea, except premiums have gone on the books at a credit, so they're going to be coming off the books at a debit. And so we're retiring these bonds at 105. We have to remove the premium, and you know. So how I think through it is I say, okay, here's the cash of 105. The bonds come off. The premium that goes with them has to come off, and here the difference is going to be a loss on the bond redemption. Okay. If we retire them at 97, same process we go through. Cash is 97. bonds at face value, premium comes off, and then in this case we have a gain on the redemption. Okay, so those are two ways of, or that's retiring your bonds before they have matured. Okay. Bonds can also be converted to common stock, and I'm not going to really ask you to do any exercises on that, but what you really need to know is that there are no gains or losses recorded on that transaction when they are converting bonds to common stock. It's going to be, the stock will come on the books at the carrying value of the bonds. And if you did a couple of journal entries on that, you could see how that works. But yeah, so this is basically what you need to know at this point, and you'll probably run into a little bit more of that later. Okay, so I think that takes care of retiring our bonds. You could look at brief exercise 14.9. That might be helpful. And we'll move on from our bonds payable now to our long-term notes payable.